2025 felt like the stock market was playing a giant game of financial chicken. On one side, people were screaming about an incoming recession. On the other side, investors were buying AI stocks like they were the last item on the shelf. And stuck right in the middle was everyone else. The economy didn't collapse. Unemployment stayed relatively low. Consumers kept spending like credit cards weren't real money. And anyone who bet against AI stocks probably learned a very expensive lesson. It was confusing, it was uncomfortable, and somehow, heading into 2026, it feels even more uncertain. Rate cuts, AI hype, recession fears, a soft landing, a hard landing, or no landing at all. All of it is still on the table. When I look at 2026, I don't see one clear outcome. I see three possible paths: a bear case, a bull case, and a gray area in the middle that almost nobody wants to talk about. So let's start with the bear case. The first problem is valuations, especially in AI. At current prices, a lot of AI stocks aren't being bought for what they earn today. They're being bought for what people hope they earn in the future. That works, until it doesn't. When expectations get too high, even small disappointments can lead to big pullbacks. The second issue is how concentrated the market has become. A small group of massive tech companies now drives a huge portion of overall market returns. Indexes that look diversified on the surface are increasingly dependent on just a handful of names. It's like a group project where two people do all the work and everyone else still gets credit. When those few stocks move, the entire market feels it. And finally, there's mean reversion. Markets don't move straight up forever. Corrections aren't rare, they're normal. The problem is timing. You can be right about valuations, right about concentration, right about excess, and still lose money by being early. That's the uncomfortable reality of the bear case. But what if the market just doesn't care? What if valuations stay stretched and prices keep climbing anyway? That's the bull case. Interest rates are coming down. Cheaper money supports higher asset prices. When capital gets easier, investors are willing to pay more today for earnings tomorrow. And then there's government spending. Large deficits mean money continues flowing into the system. That supports demand, revenues, and economic activity, at least in the short term. Bad long-term math, but strong short-term fuel. Which brings us to the most likely and most uncomfortable scenario: the gray area. When strong tailwinds collide with real risks, markets don't always crash or explode higher. Sometimes they just go sideways. Rallies fade, dips feel scary but never feel cheap enough. Narratives flip every few weeks, and nothing feels easy. These are the hardest markets to survive, because impatience does the most damage. And when markets feel like this, it's a good reminder. Nobody actually knows what happens next. If someone says they do, they're guessing, or selling you something. The best thing you can do is absorb information, think critically, and avoid blindly following the loudest narrative in the room. So as we head into 2026, those are the three paths I see: the bear case, the bull case, and the frustrating gray middle ground. Now I'm curious what you think. Do we break lower? Do we rip higher? Or do we chop sideways and frustrate everyone? Let me know in the comments. And if you want more market breakdowns without fake certainty, consider subscribing. I'll see you in the next one.